Hello and welcome to today's expert webinar presented by AccountantsWorld. We'll be getting started in about 6 minutes with Gary Boomer, who will be presenting blockchain. Also wanted to mention our AccountantsWorld did a webinar back in, I believe it was early May, and it was presented by Dr. Chandra Bansali, who's our co-founder and CEO. And he talked about the concept of moving beyond advisory services and being an advisor all the way to being relevant to your clients. And relevance means that you are actually doing those things that are good for your clients' businesses, both the things that they recognize and things that they may not even be aware of yet, but that you have the expertise to be able to provide to them. And moving into the future in a very competitive landscape for all accounting firms, being an advisor is a great start, but it's not going to be enough. If you really want to make a positive impact on your clients' businesses, Dr. Bansali demonstrated how to go ahead and start to do that with 5 very simple steps that you can begin to implement right away. So if you'd like to watch Chandra's on-demand presentation at any time for free, simply go to relevancewebinar.com. That's all one word, relevancewebinar.com, and you'll be able to download his presentation or view it at any time that you'd like to. Before I bring Gary on here, a brief word about Gary Boomer. As I mentioned, Gary is the leading authority on technology and firm management. He speaks around the globe on topics including strategic and technology planning, the mindset and skill sets and tool sets that you need for the future, and how to develop a training and learning culture at your firm. Gary is the creator of the Boomer Technology Circles. He's been named to the top 100 most influential list in accounting 15 times. And in 2015, he received the AICPA Sustained Contribution Award for his contributions to the profession. So at this time, I'd like to introduce Gary Boomer and turn the floor over to him. And Gary, are you there? All right, Gary, we are not hearing you right now, or at least I am not hearing you. Tom, are you able to hear
Now, can you
Gary?
hear me?
Yep, I can hear you now.
Okay, thanks, Deb. Sorry about that. I was on mute while you were giving the introductions and I failed to turn it off. Um, it's a pleasure being here with the group today. We've got almost 400 people on the call, it looks like, and it's a topic that whenever I hear or read about blockchain, I hear several words used. It's got great potential. It could disrupt the profession. It's just a bunch of hype. There's a lot of politics involved in this. There's going to be more regulation. There needs to be more regulation. This is a global play. It's innovative. And I have to tell you that there's something here. And I'm going to try to be as unbiased as possible today and give you a presentation that is more about how to tell time and not as much to build the watch. Yesterday, I sat through a presentation given by some of our people in a blockchain accelerator. And at Boomer Consulting, we're about 20 people. We provide consulting, education, and community services to leading firms in the accounting profession in these 5 areas. And as I said through that seminar yesterday, I got to thinking, this seems pretty technical to non-technical people, but I'm going to try to break it down and simplify it for you so that you can understand how it has the potential to impact our profession, your practice, tax, and auditing. And I think it was mentioned that Chandra had given the presentation earlier about how to move into advisory services and remain relevant. You'll see we call that playing through the line. And we're even saying now that you go beyond advisory into consulting services. And blockchain is going to force some firms to think differently. So here's kind of a quick agenda. It takes a different mindset moving into the future and being more in the consulting and advisory business than it did in the compliance. We're going to talk a little bit about the blockchain, cryptocurrencies, how they're different, how they're the same, and how the real impact here is not going to come from just blockchain, but a convergence of multiple technologies and the market demanding different types of services than what we provided in the past. So we'll look at the impact, what this could do to audit, what's going to stay the same with audit, what will change, how this disruption, what the timeline will be, some of the obstacles, and what you can look for out in the next year or so. So I want to start with this slide showing the internet. And if you go back to the early 90s, we had the World Wide Web, and that was really the information internet. Today we have a new game, and blockchain's part of that game, and it's an internet of value. Some would say that the blockchain is based upon the protocol of trust. I would say that it certainly increases trust, and the accounting profession is not new to trust, as we're one of the most trusted advisors that small businesses have. What is really old about accounting are our general ledger systems. And if you trace the general ledger system back to the Renaissance, that's what the Medici family used in accounting so that they could bring the different professions together and advance the Renaissance. And it wasn't until we had double entry bookkeeping that you could track fungible goods or even money, and you had to deliver those goods once there was a sale. And the ledger clarified all of that. And as I sat through the session yesterday, I got to thinking, you know, when I was in high school, my dad gave me some good advice. He said, you ought to take bookkeeping and you ought to take typing. He said, you want to take bookkeeping because all the girls are in the bookkeeping class. And he said, you ought to take typing because if you get drafted, and he was a World War II veteran, he said, if you get drafted, it's a lot more comfortable behind a desk knowing how to type than it is living in a foxhole. So I took bookkeeping, and in high school, we had to do practice sets. And we learned about ledgers, subledgers, journals, adjusting entries, closing entries, correcting entries, and you use pen and ink, and you couldn't go into a general ledger and delete a transaction now like you can in some of the most popular general ledger systems. And when you go in today and delete an entry, it just simply recalculates the balance. Well, part of the blockchain is built on a protocol of trust. It's immutable. And so once that block is settled and added to the next block, you can't go back and change the previous block. So there's a lot of control here that we didn't have in the past. So I'm going to ask you, because I can change this presentation kind of as we go. Dev, if you'll just bring up the question here, and we'll ask our audience kind of how they feel, a little self-assessment about their knowledge of blockchain.
Sounds great. So I will go ahead and launch the first poll question. And the question is simply, what is your level of knowledge with regards to blockchain? 3 options there. Go ahead and select one of the options and click submit. And just a reminder that voting in the poll question is required in order to earn CPE credit. This is the first of 3 poll questions that we will have today. And so we'll take about 10 more seconds for people to go ahead and get their votes in. I see about 90% of people have already voted at this point. Okay, going once, going twice. All right,
Well,
Gary, so 84%
almost
said
85%
introductory.
of our audience say they're introductory level. So that's what I had anticipated, and I'll try to provide something. I will say, as many blockchain presentations and books that I've read, I always learn something, even though I've been spending quite a little time on this for the last several years. So hopefully those that are advanced can take away at least one or two items. I know I've spoken to a lot of university professors here this spring, and very few of them had any knowledge of blockchain, and it's certainly not being talked about in the schools. And much what you read about in the press may or may not be true, and it's often the hype that we see in the press, and there's a lot of confusion over cryptocurrency and specifically Bitcoin and blockchain. So this is not new. As I mentioned, the Renaissance. So let's look back at some of the other technology that's come into our profession. You know, the fax machine really wasn't important until 1980s, but the patent on that was in the late or middle 1800s. Mini computers came in 1970s. Then VisiCalc was the first spreadsheet. The IBM PC in 1981. Quicken QuickBooks in 1992. The laser printer. You know, these have all been revolutionary. And I tell people that it's my belief that blockchain has the same potential to disrupt our profession significantly. And some of these others regulations come about. I think there's got to be more regulation with regard to cryptocurrencies. I think some can be good, some probably will be bad. And that's one of the things that will probably hold up the adoption in the marketplace. So 2008 is when blockchain really started, and we're now 10 years into that. So this is going to happen much quicker, and I'll give you an example here of why I believe it will happen quicker. If you look at this interface timeline, and the first thing is the internet back in 1994. Most of you can remember that, or many of you can remember it. And then we had the iPhone that came in 2007, and now blockchain in 2018. Well, if you look back, we needed an interface for the general public and the market to adopt the technology. And that interface really came from Netscape in 1994. And then the iPhone, what made it happen was the App Store. And all of you that have iPhones or any type of phone today, it's not the telephone that adds the value, it's all the applications that add the value. And so blockchain, we don't know who's going to provide that interface, but there's a lot of companies out there today trying to do that. And I watched yesterday as a programmer actually prepared an application program for the supply chain of a fungible good from the grower to the importer to the seller, and monitoring the temperature of that good throughout the process. And they did that in less than probably 30 minutes. And so I was pretty impressed about how that technology really worked and can be used in our profession. And later on this afternoon here, I'm going to give you some examples of companies that are using blockchain and where I think the adoption is coming first. So this is going to change your thinking. And the easiest way to understand something is think exponential rather than incremental. And as accountants, oftentimes we've been trained to think incremental or way too small. And we think that it's only entrepreneurs and big thinkers, just none of that ever comes to fruition. But a lot of this has come to fruition from exponential thinking. And I think in your own firms, I would encourage you to do that when you have problems. Think what you'd do if you were 10 times the size you are today. So this all started back in 2008 in a white paper with unknown person or person named Satoshi Nakamoto who wrote that white paper, and part of it was from the fall of Wall Street and the stock market and the mortgage crisis. And he was trying to design a system that had a currency that could be protected and didn't have an intermediary. So some have said blockchain is just a database. Well, it's more than a database, as you will see, but that's okay to define it that way.
Folks, it sounds like we are not getting Gary's audio here. If somebody could let me know in the questions tab if you're hearing me here, just so I can make sure this is on Gary's side and not overall on the presentation, that would be great.
Dave, we can hear you.
Okay. Okay. So Gary, it looks like we're not able to hear your presentation there.
Gary, if you could go into the application menu and unmute yourself. There we go.
Money in the physical world can. But Bitcoin is just the beginning for blockchains. In the future, blockchains that manage and verify online data could enable us to launch companies that are entirely run by algorithms, making self-driving cars safer, help us protect our online identities, and even track the billions of devices on the Internet of Things. These innovations will change our lives forever, and it's all just beginning.
Gary, 5 seconds. Could you restart the video for everyone since we're coming into the middle of it? I'm sorry.
INPF.org/blockchain.
Okay, I think some of you apparently heard the last 1/3 of that. I didn't realize, but some way I got muted again. I'm going to go ahead and go to the next video, even because I think we will describe what was going on there. It was an overview of what blockchain really is, and the pictorial part of that, or the graphic part, was pretty self-explanatory. I've got 2 other videos. In those videos, men seem to understand this video better, and the last one, the women understand better. And you'll see why in just a moment. However, this video is a little bit, it's a CNBC video, but I'm not sure how accurate it really is, because this talks about how criminals are using blockchain. And I think, if anything, criminals want to stay away from blockchain. But I will let you kind of be the guide here and go ahead and play this video. And I'll make sure that you can hear it. Please stop me right away if you don't hear it. Whoops.
If you're a modern criminal, chances are you've used it to buy guns, drugs, and even launder money. Sounds dodgy. But high-profile institutions such as USAID and UNICEF have a different view. They think it could be a force for good, helping the poorest people in the world. It's a technology called blockchain, a global online database that anyone, anywhere with an internet connection can use. Unlike traditional databases, which are owned by central figures like banks and governments, a blockchain doesn't belong to anyone. And with an entire network looking after it, cheating the system by faking documents, transactions, and other information becomes near impossible. Here's how it works. Blockchains store information permanently across a network of personal computers. This not only decentralizes the information, but distributes it too. So how can a multi-purpose online database whose users include criminals work for everyday use? How does it stay relatively hack-proof? The answer is blockchain's millions of users. They make it difficult for any one person to take down the network or corrupt it. The many people who run the system use their own personal computers to hold bundles of records submitted by others. The records are known as blocks. Each block has a timestamp and a link to a previous block, forming a chronological chain. It's like a giant Google Doc with one key difference. You can view it and add to it, but you can't change the information that's already there. The blockchain enforces this by using a form of math called cryptography, which means records can't be counterfeited or altered by someone else. Blockchain's most famous application is Bitcoin. It's a digital currency that is created and held electronically, and you can send it to anyone, whether you know them or not. Bitcoin provides a level of anonymity we've not seen in modern times. That's because, unlike credit cards and PayPal payments, there are no middlemen such as banks and financial institutions asking for our personal information and home address. Instead, people from all over the world move the digital money by validating other people's Bitcoin transactions, earning a small fee in the process. Where the blockchain comes in is verifying the ownership of this digital cash and making sure only one person is claiming it as their own at a time. Banks and businesses are rushing to adopt blockchain database technology. In a survey of 308 senior executives at US companies with $500 million or more in annual revenue, Deloitte found that 28% of respondents had invested $5 million or more in blockchain technology. 10% had invested $10 million or more. But why are they spending so much money? Well, to save money, of course. When this study looked into the data of 8 of the world's largest investment banks, it found that blockchain could save them between $8 and $12 billion every year. Bet that $5 million investment doesn't sound so bad now, but it's not all good news for the big players, of course. Blockchain lowers the barrier for entry into the banking industry, and that means fintech startups are popping up in pretty much every market they operate in. If banks and companies can't keep up, they're putting their own survival at risk. For the consumer, the future seems brighter with more security, less cost, and better experiences. Yet, blockchain could be the biggest game changer for the poorest in society. The technology is open to people living in low-income countries or fragile states at risk of economic collapse. Take a farmer with a small plot of land which is then flooded. The paper copy of the deeds to his land is washed away, resulting in the farmer having no proof of owning the land. Or perhaps he does have a digital copy on a government database, but it is erased, altered, or even destroyed in a political coup. If the farmer had filed that deed on a blockchain, he could have avoided all these problems. Along with speeding up the flow of cash and providing a secure place to keep records, the benefits for the poorest in society are enormous. From protecting our identities to running autonomous vehicles to managing a world that is increasingly dependent on the Internet of Things, the possibilities of blockchain technology seem endless. But whether it lives up to its promise remains to be seen.
I'm going to mention 3 things here while you take another poll. And the polling question is, do you own any cryptocurrency? And the 3 things that I would like to have you take out of that video was 1, identity and protection of your identity. Because right now there's a central authority that issues any identification that you have, whether that's a passport, a driver's license, a social security card. A government authority issues that. under blockchain, you could have sovereign identity. And what do I mean by sovereign identity? If a person were going to go out for an evening and have a cocktail, and the bartender needed to card them to find out whether they were 21 years of age or not, right now they hand them a driver's license or a passport, and it shows not only their name and the date of birth to prove they're 21 years old, it also provides a lot of other information that that bartender really doesn't need to know, like your name, address, eye color, weight, and a lot of other things. Well, with blockchain, only the information that needed to go to that bar or restaurant would be purveyed to them. So the one thing is on identity, two, essential authorities, and three, there was a lot of talk about banks and how much they're investing. Well, think about the disintermediation of how banks could be taken out of their role as the intermediary and the collection agency for all transactions. That's why they're investing in this. And you will learn a little bit later on in the program today that there are two types of blockchains. One is a public and the other is private, or permissioned and permissionless. And the banks are really using permissioned blockchains to transfer money faster and cheaper in order to compete and not lose out. So let's see if any of you own cryptocurrency. How'd that poll turn out?
All right, so we are just about done with that poll. So if you haven't voted yet, folks, please go ahead and do so right now. We'll take just a few final seconds here. So the question is, do you own any cryptocurrency? Very simple, yes or no. Make sure to click the submit button. We'll take just 5 final seconds here. Going once, going twice, and closed. Okay, so Gary, we've got a 10% to 90% split here. 10% of people own cryptocurrency.
Okay, I hope that 10% didn't buy in the fourth quarter of 2017, and I hope they bought much earlier in that. And if they were fortunate enough to sell back in the fourth quarter or first quarter of this year, they probably made some pretty good money. There's a cost to education. And sometimes investing a small amount in cryptocurrency, it's difficult. I will tell you, I think the 10% that own something will tell you that the process to go through is the wild, wild west. There's a lot to learn about how you can transfer cash from your bank into an agency like Coinbase or Bittrex. And you need to learn how to do that for the future, but I will say you it's risky, and I would start with very small amounts if you're going to learn how to do this. So Bitcoin was really the first application, and it's the first crypto that was built on the blockchain, and it's decentralized. There's a distributed ledger, and many of you've learned about mining. And mining is not what I would recommend for anyone probably on this call today. Maybe in the early days, and we're still in the early days, mining may have been something that somebody really technical wanted to invest in, and it would have been okay. But I just don't think that's something for most of our listeners today to get into. But there are over 1,600 coins today. And Bitcoin is probably the most known, and it's the oldest of all of those. So what's driving all this? What's the technology, and how's that going to impact the CPA profession? Well, one thing are networks and sensors in the Internet of Things. We're automating more and more steps in all of our processes. Secondly, are smart contracts, which are based upon blockchain technology. Then cognitive computing, much more powerful computing. We know that the processing power and the bandwidth and the storage capacity have all been doubling about every 18 months for the last 30, 40 years. And then blockchain comes into picture here, robotic processes. And these aren't robots walking around your office necessarily in an accounting firm, but robotics can be anything from machine learning and how you automate processes so that you don't have human intervention. It's already been proven that you can code transactions much quicker and much more accurately without a human involved if you have the right system. So systems and technology aren't that relevant if you don't have the right processes. So in the future, I think you really need to be thinking strategic. You need to be proactive about blockchain. You need to think about where can we add value with this, or where is it just another step in a process that really isn't a value add? How do we reduce the time and cycle time of delivery of service? And how do we get information more on a real-time basis rather than be so precisely accurate, we think, 30 days, 60 days after the transaction? And how do we use all that knowledge to utilize algorithms and predictive math? Many of you, like myself, had to take statistics in college. I've even gone back and looked at a lot of that because it's more relevant today, and the algorithms that are built into the software. So this really takes us into the process area. And any of you that are familiar with Lean and Six Sigma, define, measure, analyze, improve, and control, it's a system where you continually improve your processes and standardize them. And if anything, in the accounting profession, tax processes have way too many loops. They're inefficient in getting the information from the client to the CPA, and then getting the finished product back out, getting the payments made. And there are ways to automate that today, and blockchain has the potential to be part of that. So let's look at this continuum of value. And this is what I think Chandra was talking about earlier this year when he said you have to move over into the advisory role. Now, down at the bottom, we have this transaction and compliance piece that we've been doing. And I'm not saying you should stop that. This is an and proposition, but you may want to package it and price it differently than you've done in the past. Then we get into the performance and the strategic and the consulting, and this is all advisory type services. Right now, you will see there's a business transformation going on with your clients. There's a digital transformation going on internally with those clients and in your own practices. And to be innovative, you have to have hindsight, insight, and foresight. Innovation is just not a moment that appears that's an aha moment. And to do this today, we have disparate systems where the information doesn't flow, and you have to have data connectors on the left-hand side, and those are red going from one system to another if you're not in the cloud. And our tax providers have basically held us back because their software does not interact with cloud-based systems as easily as it should. So it should be one push of a button and you can produce a compliant financial statement. Another push of a button, you can produce a tax return, rather than have to have trial balances and adjusting entries in there. Those should all be built right into the system. As you get over on the right side in the more relevant services and the higher dollar services, that's where knowledge comes into play. So you need knowledge connectors, and it's more than just accounting. It's data analytics, it's project management, it's predictive type services. If you look at the left-hand side, that's limited by your capacity, and people are hard to find today. It's very competitive. But over on the right side, it's your capability. So through collaborative skill sets that are beyond just accounting and compliance. And the capability of the technology, you can move up the value chain. And this is the continuum of value that I'm going to refer to later on again. So this creates innovation. I'm going to show you another video about how the blockchain works. And this is the one that the ladies tend to like the best. There we go.
Since the days of clay tablets, people have recorded the exchange of goods and services. As we evolve into the digital age, recording these transactions has become much more complex. Whether it's the exchange of money between two parties, documenting how goods move through a supply chain, or making contractual agreements. The growth of global commerce and trade has created a network of disparate ledger systems, vulnerable to errors, fraud, and misinterpretation. Take the diamond industry, for example. The journey of a diamond from mine to consumer covers a complex landscape of legal, regulatory, financial, manufacturing, and commercial practices. Current supply chains have to rely on intermediaries every step of the way, from government officials to lawyers, accountants, dealers, and banks. This adds time and cost. Diamond smuggling and fraud can hamper governments from collecting fair export taxes, and consumers and retailers face the prospect of purchasing counterfeit or unethically mined stones. This is where Hyperledger blockchain technology comes in. It has the potential to eliminate these vulnerabilities with transparent transactions. Blockchain offers all parties involved in a business network a secure and synchronized record of transactions. The blockchain ledger records every sequence of transactions from beginning to end, whether it's hundreds of steps in a supply chain or a single online payment. As each transaction occurs, it's put into a block. Each block is connected to the one before and after it. Groups of transactions are blocked together and a fingerprint of each block is added to the next, thus creating an irreversible chain. That's why blockchain is ideal for recording the mining, refining, and distribution of one of the most valuable goods in the world. It can trace a diamond's path from the mine to the hands of the consumer with exceptional security and transparency. While blockchain works with all types of transactions, there are three key features that make Hyperledger blockchain uniquely capable to handle the requirements of a regulated industry like diamonds. It's distributed, it's permissioned, and it's secure. Because the ledger is distributed, it works as a shared form of record keeping, ensuring no one person or organization holds ownership of the system. As the diamond cycles through its supply chain, everyone involved during the process is permissioned to have a copy of every record and piece of data, and no transaction can be added to the chain without consensus across the participants. This means no one person can add to or alter the blockchain without it being permanently recorded, making it tamper-resistant and highly secure, eliminating the risk of fraud and error. No one, not even a system administrator, can delete it. In the case of diamonds, a blockchain ledger keeps a record of high-resolution photos of each diamond at every touchpoint along its journey. It holds certificates of authenticity, real-time records of every payment transaction, as well as product details like cut, clarity, color, carat, and diamond serial numbers. At the end of the buying cycle, there is a complete, auditable, and indisputable record of information. Blockchain technology gives us the ability to transform industries of all sorts, from diamonds to flowers, monetary transactions, or even things like contracts, deeds, records, and other public and private agreements. It frees up capital flows, speeds processes, lowers transaction costs, and most importantly, provides security and trust. We believe that blockchain will do for business what the internet did for communication, create new ways of working and leave more.
Sorry there, I cut that off, but there's a couple of things I would like you to take from that. One, it was a distributed ledger and it was titled Hyperledger. Hyperledger is an IBM system that is built on the blockchain. And I probably said this earlier, but I'll say it again. What's really important is the platform of the blockchain, not necessarily the cryptocurrency or the token. And in this case, Hyperledger, I would say that some of the adults have entered the market now. Companies like IBM, some of our software vendors, Intuit, Thomson, they've entered into the Hyperledger area. And I think this is important. But this is where some people are saying this is really triple entry bookkeeping, because the reconciliation happens at the time the block is closed out. Now, here's the issue that you have with a cryptocurrency like Bitcoin. Bitcoin could not replace our credit card system because of the volume of transactions today and the fact that it takes about 10 minutes normally to get that transaction reconciled. And the system can only handle about 5 transactions per second. And there are thousands of transactions per second going over the credit card system of Visa, MasterCard, or others. So it's good. There are some challenges ahead, but the technology is improving greatly. But I think the other thing are these smart contracts. If you have a contract and it has certain things, like for music, if I buy music and I want to use it for a ringtone, it has a different cost than if I buy music and want to use it in my office to entertain my clients in the waiting area, versus if I just play a song on my iPhone at home to enjoy. So that's one of the ways that smart contracts. The other would be in real estate. If any of you have transacted a real estate deal recently, you know that there are significant changes there and more automation. It's not using blockchain yet, but it will. But here's a good chart that shows a centralized clearinghouse like a bank versus a distributed ledger. And this is just one of the basics of blockchain. And we can go back, one of the phenomenon that you have in a blockchain are the more nodes you have on a network, the more valuable that network is. It's the same principle. It's called Metcalfe's law, and it applies to the blockchain. This just happens to be a slide showing a lot of events. One thing that I will mention, that it's going to change our processes a lot, and this is put in here for humor, not for to be critical, but some of our processes add very little value. And Rube Goldberg has a contest, even a foundation, where they look at cartoons like this and things that have a lot of action but very little value. And I put this in just so we think about our processes. The technology sometimes is capable, but our processes are so inefficient that we can't leverage the technology. Excuse me. So here you might ask, how does this impact the audit of the future? Well, the audit assertions that we have are still going to stay the same, I believe, but some of that's going to be at the point of the transaction, not 30 days, 60 days, or a year later. But you're going to have to be concerned about cutoffs. How do you get a cutoff today? Normally it's at the end of the day, end of the month, end of the year, and you rely on the bank or the third party. But if you had cryptocurrency or Bitcoin exchange, how do you value that? Which block do you go to? These are all questions that people are having to address, and there's not enough guidance out there in the marketplace today. So here's what I think you need to focus on is, how can you be more efficient? How can you do more with less? Excuse me. And really use the technology to provide a more secure and private environment, and automate as many processes as you can, and continue to sustain trust in the system, because that's what accounting has been built on, is a system of trust. The transparency and the auditability of the system is also important, and this will provide you a competitive advantage. Now, I hear all the time, well, the big four is investing a lot in blockchain, and they're going to take over a lot of the larger accounts we have. Granted, the big four is investing in this technology, but it's not in their audit practices. It's in their consulting practices, and they're looking at ways to provide faster, better, and more efficient services to their clients. And they're using algorithms, they're using things like blockchain. And it's also driven by the distributed ledger technology, and I mentioned permissioned and permissionless. It's also be driven by globally systemic important financial institutions, know your customer, KYC regulations, and we have regional SIFIs, and it's any kind of object or asset, not just funds, are being tracked on this system. Real estate, processes, and it's all important for us to know that you can do so much more than just the financial transaction with this. So visionaries tend to see what's invisible to others. This has been around since Gulliver's Travels. Jonathan Swift came up with that back in the 1700s. And so you could say this is a vision. It's in reality today. We're seeing it happen. The programmers are doing it. It's hard to find blockchain programmers today. Don Tapscott was one of the first authors that I read about, and he certainly is a proponent and says that it will change the way commerce is done around the world. Rod Drury, on the other hand, with Zero, said we're too tribal. He didn't think blockchain would be that important to us as an industry. So there are different opinions here, and I'm not trying to say that it's going to be the next big thing and you need to worry about it next week. But here's an EY executive, you know, we need to know what questions to ask. But here's some other things that as you move into this technology and go to a distributed ledger versus the general ledger, you'll have 10 to 100 times the computer processing power. You'll have more security. It'll improve and be able to predict your cash flow. It'll have more mathematical and calculation functions built into it. It'll also have the capability to analyze big data. And these are all things that we have been looking for. Here's another Big Four firm, a comment that say you can't wait until the market comes to you. You've got to be making some investment. And I would say the investment the smaller firms should make would be more in your education and knowing kind of what the timeline is. Deloitte probably is one of the leaders and has the most professionals working on this around the world. I would say that we're also a little bit behind in the US compared to global Big Four companies. But there are a lot of companies investing. At Boomer Consulting, we're trying to learn as much as we can about this and stay ahead of the market because our clients are very interested in it. Here's the hype part. You know, there was a lot of hype on it. A year ago in June, we were kind of coming down the slope. I think we're a little bit further. And now that technology is starting to be proven that it really works and it's not just all hype. Gartner is the one. So I'm going to quickly give you some examples of how blockchain is being used, and then we'll stop so we do have a few questions, and you can certainly go through the rest of the slides that are in the deck. But one of the ways blockchain is used today in a pilot program by Walmart is tracking all their fungible goods, not fungible goods, all their goods that have a shelf life on them. And they can track to see that if they haven't sold, they get them off the shelf. And it's also in shipping where they track containers. And if you, for example, were shipping bananas, there's a storage point that if those bananas stay at a certain temperature, they will remain in a dormant state. If they go above or below, they could be damaged, and then they wouldn't be worth as much as they are. This shipping Mazric line is actually using this. The music industry is using it. And so when do I think this is really going to hit the accounting profession? A year ago, I probably would have said earlier than I will say today. And you look back at the start in 2008, you see a lot of contracts, smart contracts start in 2017. But in the accounting profession, I think it's going to be in the early 2020s before the accounting profession really catches up because we're behind. I hope I'm wrong here, but I think we're going to see it probably in 2022, 2023, where it could replace some of the legacy systems out there. Now, that's a guess today, and that's an opinion based on the best information I have, but at least it kind of puts us in some perspective, hopefully, for you. Now, here's kind of an alternative. The thought leaders really started talking about this back in 2015, and then some firms, the big firms in particular, started building some capacity. And then in the future years, whoops, we just lost it. That's going to be a good time to stop right there and ask if we have any questions, Dave.
Okay, we've got a couple of questions. So Mark wrote in and said, when do you think we'll see blockchain in retail type general ledger accounting packages?
I would say probably not for 2 years. There will be some pioneers out there soon, but I don't see it for a couple of years based upon what I know today.
All right. Shiri asks, how can an auditor confirm cash balances on blockchain? Are there more reliable blockchains than others?
The answer to that is there are software companies today working on being able to pull those currencies from multiple locations. In other words, I didn't get into cryptos much about the Coinbases, Bittrex, and those others, but there are companies working on being able to get multiple currencies into one location so you can confirm and value as of a certain date. So yes, people are working on that. I can't think of there's a company in Atlanta right now that's doing it for a CPA firm there in Atlanta. Aprio is the firm, and I'm trying to remember the name of the company, but we need some more standards. Yesterday, I was in a meeting with a member from the auditing standards, and his takeaway was we're going to have to act quickly on this because it's hitting our clients quicker than it's hitting our actual practice.
All right. Philip asks, you mentioned quote unquote a smart contract. What does a smart contract mean?
A smart contract is a contract that has various things that can be executed, and the machine is able to actually do the execution. For example, you could have payments that are monthly, and those payments could be based upon certain factors, and there could be bonus rent. Those can be calculated and paid automatically based upon that smart contract and the machine's ability to read that contract.
All right. Kishore asks, are there FBAR requirements related to cryptocurrency?
There are more regulation, and we didn't get into that today, in that I heard this yesterday, it's not my monkey, it's not my circus, and now everybody thinks it's my circus and my monkeys. The IRS is into this, Securities and Exchange are into it, and we didn't talk about ICOs versus IPOs, but absolutely we need some guidance. And if the US would get more guidance in this area, I think we would move forward in our capital markets quickly, because there's a lot of unknown about even taxation. And the AICPA has asked the IRS for more guidance. There's a lot of misinformation about taxation of these transactions.
Hey, Div, while we're
Yeah.
chatting, can we get the third poll question launched?
I was just going to say that. So Gary, if you don't mind, can I go ahead and launch that third
Please.
one right now?
Yeah, I'm
Okay.
sorry that blew up. I don't know what
Oh,
caused.
no worries. We're fine here. So folks, I just went ahead and launched the third poll question, which is, do any of your clients utilize blockchain technology to your knowledge? Either yes or no there, and then click submit. One other question that came in here from John, do you envision a cryptocurrency that is pegged to the dollar or some other currency so that it will have predictive value? If I sell my house for 400K, I want to know that the crypto will still have 400K value in a week.
Well, that's one of the differences of the crypto market, is that it's not tied to any government or any centralized um, authority. However, he's absolutely right. People aren't going to deal in a crypto that has too much fluctuation or volatility. So the market's going to have some control and regulation. If you just look at Bitcoin, the price has gone from maybe 4,000 to 5,000 up to almost 20,000 and back down to 6,000, 7,000 in the last year. So there's a lot of volatility. And what do you do if you receive payment as a firm in Bitcoin? You get that converted back to cash or another currency as quickly as possible. There's got to be a lot of policies and procedures put in place here.
All right, and one last question, and folks, poll question is still open here if you haven't voted yet, so please go ahead and do so if you'd like to get CP credit. One last question from Shiri. Is there a minimum number of miners required to verify a transaction?
The answer to that's yes and no. You have to have a minimum number, and you have to have 51% or more. And that's one of the risks here. If someone were to take over a market like the Chinese or some other country, and then they could control the mining of that crypto, then you would have a problem. So that's something that, yes, you definitely need to be concerned about. And I personally have invested with a couple of different services. Stansbury Church House is one, and Palm Beach Capital is another, to learn how to do this, because it's risky. And of those 1,600 cryptos, there's probably not over 15 or 20 that I'd want to own.
Good to know. All right, so I'm going to go ahead and close out the final poll question here. And so 93% of people said they do not know of clients who are utilizing crypto at this time. Gary, are you surprised by that result at this time?
Yes, I am a little bit surprised, because in yesterday's meeting, almost all of the CPAs, and that's maybe why they were at the meeting, had clients that were sitting on big gains in cryptocurrency, or they had companies that were accepting payments in crypto, and they were looking for standards and policies of how to handle those. So I think it's certainly going to be something that's going to impact our audience more in the next year.
Great. All right, so I want to thank Gary for his time today. We're right at the top of the hour, and I want to make sure I get you guys out of here in just a minute or two. But Gary, thanks for all of your information today and for answering all these great questions that have come in. Also wanted to remind everybody on July 26th, which is a Thursday actually, rather than our usual Wednesday, we'll have our next expert webinar, which will be Brian Tankersley of K2
Hello,
Enterprises.
Div. You're actually starting to scratch up a little bit on your audio, so I'm just going to take over here and finish for you, if that's all right.
Sure.
Hi, guys. I'm Tom. I'm one of the marketing coordinators here at AccountantsWorld. Like Div said, we just wanted to thank you for joining us today. We want to thank Gary for taking the time to share his knowledge of blockchain. And we also wanted to let you know about the next expert webinar, which is taking place on July 26th. It is with Brian Tankersley of K2 Enterprises, and he will be speaking on artificial intelligence and machine learning, a roadmap. So that should be a very interesting topic. And you can register at 2018webinars.com. And if you are interested in Accountants World and for a live personalized demo of some of Accountants World solutions, you are more than welcome to go to our website, accountantsworld.com, or you can call us at our toll-free number, 888-999-1366. That should be all for today, folks. Thank you so much for joining us, and we hope to hear from you soon. Bye-bye now.